The basic problem felt around the Western world is that housing supply is not keeping up with demand. As real prices thus rise, housing costs take up a larger part of people's spending, leading to affordability issues. Really, that statement is tautological though. Affordability simply refers to how large the share of housing costs in people's overall spending is. In part, it's economic. Interest rates are not zero anymore, and higher incomes through economic growth translate to higher demand for everything, including housing. In part, it's cultural, with a trend towards fewer people per household. But to a large extent, it's a regulatory problem. And given the costs and inefficiency of subsidies to increase supply, outlined in Part 1, deregulation presents an air quotes free boost to supply. It is free in the sense that the government does not have to spend money, so there are no direct costs. If regulations improve market performance by fixing market failures, removing them actually shrinks the overall pie and lowers standards of living. Also, unlike supposed sudden increases in landlord or developer greed as causes of higher prices after long periods of generosity, I guess, regulation is a problem that we can actually tackle. How can we tell how much regulation inflates housing prices? In efficient markets, there are no economic profits, meaning everything sells at the cost of producing that thing. So the price of a housing unit should be about equal to the cost of producing that unit. The regulatory requirements will increase the market price like a tax applied to housing. Order of magnitude, this quote-unquote tax increases prices by tens of percent. It increases the price of housing by up to 50%, 50, in highly regulated areas, but usually more in the 20 to 40% range. In principle, this regulation could internalize externalities, making the price increase socially desirable, like taxing gasoline to accurately reflect the costs caused by CO2 emissions in the price faced by the gasoline consumer. For economic details, check Part 1 though, but examples include noise ordinances, pollution regulation, or zoning how close industrial areas can be to residential ones. But actually looking at the numbers, people generally conclude that these externalities are just not large enough to justify the actual costs of regulation. Again, those 20 to 50% of increased costs. That is because, in reality, regulation does not just try to achieve a state of enlightened neoliberalism, but also tries to achieve specific policy outcomes like ensuring minimum housing standards. Information asymmetries may justify regulating the risks of low-quality construction, but minimum standards are more likely actually caused by an aversion to visible inequality. Clearly, the lower standards in poor countries far away matter less to people than seeing medium standards right next to high standards of living. Fostering socially mixed urban structures is also a specific policy outcome people try to achieve via regulation like zoning that is not just fixing a market failure. And of course, current residents will try to rent seek by lobbying for regulations that increase the value of the homes that they own or decrease the price of the apartments that they rent. The costs of regulation are in the direct fees developers have to pay, the time and effort invested into approval processes, the associated uncertainty of potentially wasting all these planning efforts with zero return, and the effort and maybe extra costs to abide by standards. The extra costs to the consumer are due to the higher costs to developers directly, but also just supply and demand dynamics. Restrictive zoning and regulation that makes it unprofitable or impossible to build certain kinds of housing limit the supply of housing without affecting demand, so the price increases. Some negative consequences of lower supply and higher prices are the inefficient allocation of labor, low supply preventing people from moving to where they are most productive. But this also includes sentimental values, like being unable to live close to your parents. It will lead to increased inequality, since housing isn't optional and poor people spend more on housing as a percentage of their income. It will cause worse environmental outcomes, since new buildings are more environmentally friendly. And at the limit, it's homelessness, whose rate has, in fact, increased in OECD countries. And while you might think increased housing prices are beneficial to homeowners for building wealth, to the extent that is true, it also makes it harder for young people who aren't homeowners yet to tap into that source of building wealth. It would be a transfer from presumably older homeowners to presumably younger non-owners. Not that this is a good way to invest your money, but even if you think it is, someone's benefit is someone else's cost in this case. The regulatory tax is more expensive than the negative externalities of new buildings. Reducing the costs of regulation, meaning deregulation, is therefore a net benefit to society. Zoning refers to the legal rules around how private land can be used and developed. This affects building characteristics such as height, number of stories, and overall size, lot requirements like minimum lot sizes and the percentage of a lot that can be occupied, or a density of population and the allowed uses of land, for example residential uses, commercial uses, or industrial. It's called zoning because local governments divide a community into different zones with different types of allowed activities and developments. Legally in the US, zoning is considered a legitimate exercise of a local government's police power aimed at promoting the health, safety, morals, or general general welfare of the community. Modern land use regulation along these lines began in the 1910s in the United States. Its purpose is supposed to be to reduce negative externalities while enhancing positive aspects such as access to employment and green spaces. In the US, zoning was initially controlled entirely by the municipalities, meaning local governments. Prior to the 70s, individuals and groups who were dissatisfied with a development project that had been approved by local authorities generally lacked so-called legal standing. Then, in the 70s, federal laws like the National Environmental Policy Act, NEPA, the Endangered Species Act, and the Clean Water Act, plus state counterparts, expanded to could challenge development projects. For instance, NEPA's review requirements provided an avenue for local residents to voice opinions on projects, and neighbors and activists have become better organized at using these to game the system, raising complaints that might seem minor, such as concerns about migratory birds or light pollution. The number of procedures local authorities had to follow increased, and the cost and delay associated with environmental impact statements and subsequent administrative and legal challenges became a significant hurdle for developers. Formal zoning authority in the United States is exercised primarily at the local level, with the specific institutional structure varying by state and municipality, but generally involving three main bodies. The local legislative body, such as a city council in cities or a county board of supervisors in unincorporated areas, has ultimate control over the zoning ordinance, the legally binding document that establishes land use districts, permitted uses, and so forth. This body also amends the ordinance or votes on large-scale rezonings. Its decisions are often shaped by political considerations, public hearings, and input from both developers and neighborhood groups. Day-to-day administration and long-range planning responsibilities are typically delegated to a planning board or planning commission, usually appointed by the mayor, council, or other local authority. It prepares the plan that guides zoning policy, drafts amendments to the ordinance, and reviews development proposals. Planning commissions often act in an advisory role to the legislative body, though in some jurisdictions they have final approval authority for subdivisions or site plans. Separate from the planning function, a zoning board of adjustments or a zoning board of appeals handles requests for relief from particular applications of the zoning code, like when a property owner faces unnecessary hardship under the current rules. It also hears appeals of zoning enforcement decisions made by administrative staff. These boards operate in a quasi-judicial capacity, applying legal standards set out in state enabling acts and local ordinances, and their decisions can typically be appealed to the courts. Obviously, the level of all of this regulation affects the amount of new buildings and real estate prices in an area, not just theoretically, but also when quantifying the level of regulation via the Wharton Residential Land Use Regulatory Index. But the economic impacts of zoning also involve redistributing the gains of building. Take downzoning, which means reducing the density allowed on a piece of land, for example from apartments down to single-family homes. The value of the plot itself goes down because there are now fewer legal uses for it, but the value of the surrounding land goes up because the negative external effects imposed on them go down. Less traffic, pollution, noise, and so forth. And future developments around it have become more predictable. Existing homeowners are therefore the main voting demographic enforcing stricter zoning regulations. They benefit directly in the form of higher property values. But there may also be an exclusionary motive of keeping out demographics that cannot afford the costs these zoning restrictions impose on new buyers. Even the municipality may have this motive when zoning for large minimum sizes. It keeps out relatively poor households that might cost more in services, in schools and police and so on, than they contribute in taxes. This is called fiscal zoning. This is not an actual solution to poor households though. You're just moving them around. Wherever they end up living, they will still be similarly productive or unproductive. Hence, fiscal zoning has more a quality of cream skimming. While simply doing less of all of this would be a form of deregulation, there are also more specific policy approaches. There is by right development. If a development project satisfies all published zoning regulations, the local authorities would be legally obligated to issue the permit and it cannot be denied. The point is that there need to be clear upfront standards. This stands in contrast to systems where projects are subject to open-ended discussions about their impact on the character of the neighborhood and other subjective criteria for approval. You can do entirely without top-down zoning like Houston, which instead relies on smaller scale regulations like off-street parking requirements and also private restrictive covenants, often enforced by homeowner associations. This produces more mixed-use development, mixing residential and commercial for example, and greater divergence in adjacent building types. Even more radical would be to have no restrictions at all. If you own property, you can simply build on it. Harms would be adjudicated ex post by neighbors taking you to court if your building causes them damages, sidestepping lengthy ex ante approval procedures that bias against new building. The US also runs programs that subsidize supply, encouraging more building, demand, giving poor people money, or provide housing directly via public housing. I talked about the economic effects of these programs in part 1, so here I will just give some texture to the legal details. The Low-Income Housing Tax Credit, LIHTC, is the main federal program for encouraging private investment in affordable rental housing. Created under the Tax Reform Act of 1986, it is administered not by the US Department of Housing and Urban Development, HUD, but by the IRS, which is part of the Treasury. The mechanism is indirect. The federal government allocates tax credits to state housing finance agencies, HFAs, based on population. These agencies then run a competitive application process where private developers propose projects that meet state-defined priorities, for example, geographic targeting or housing for special needs populations. Winning developers receive an allocation of tax credits, which they typically sell to investors, often banks, in exchange for equity financing their projects. This reduces the debt burden on the development and allows the units to be rented at below market rates. The investors benefit from a dollar-for-dollar reduction in their federal tax liability over a 10-year period, provided the project remains in compliance with income and rent restrictions for at least 15 years plus an extended use period. LIHTC does therefore not spend public money on construction. It is a tax expenditure. Voucher programs, most prominently the Section 8 Housing Choice Voucher program, take the opposite approach by subsidizing demand rather than supply. Instead of building or financing new housing, the government provides low-income households with vouchers to rent in the private market. Administered by local public housing authorities, PHAs, with funding from HUD, these vouchers cover the gap between 30% of the tenant's adjusted income and the local so-called fair market rent, which is set by HUD. Landlords willing to accept vouchers sign contracts with the PHA and must meet certain housing quality standards. In theory, this lets recipients choose where to live, potentially accessing better neighborhoods and schools. In practice, availability is constrained. PHAs maintain long waiting lists, and landlords in many areas refuse to participate, either due to administrative hassle or discrimination against voucher holders. Voucher programs are politically attractive because they avoid direct government ownership of housing and leave allocation decisions to the market. Public housing is the most direct form of intervention, government-owned and managed housing for low-income residents. It is overseen at the federal level by HUD's Office of Public and Indian Housing, but day-to-day administration is handled by PHAs again, which own and operate the buildings. Federal involvement in building public housing peaked in the mid-20th century. Since the 70s, new construction has been rare and policy has shifted towards rehabilitation, demolition of distressed projects, and replacement through mixed-income developments, for example via the Hope 6 and Choice Neighborhoods programs. The legacy stock is aging, under-maintained, and shrinking, partly because subsidies for operating costs have not kept up with the actual costs, leading to deferred maintenance and demolition without equivalent replacement. Two of the largest flexible federal funding streams for housing and community development are the Home Investment Partnership Program, or HOME for short, and the Community Development Block Grant, CDBG. Both are administered by HUD and operate as block grants, meaning federal funds allocated to states and local governments according to a formula, with recipients given broad discretion within statutory limits to design and implement programs. This contrasts with categorical grants, which earmark funds for narrowly defined purposes and is intended to pursue national policy goals. Home funds, distributed primarily to states and larger local governments, must be used for affordable housing activities such as constructing, rehabilitating, or acquiring housing for low-income households, or providing direct rental assistance. CDBG funds, allocated more widely, can be used for a broader set of community development purposes, including also, for example, public services, as long as they primarily benefit low and moderate income residents. Both programs require matching contributions from localities and are subject to HUD oversight, but they leave considerable room for local priority setting. Project-based rental assistance, PBRA, is an HUD-administered subsidy mechanism under which the federal government contracts with private owners to make specific units affordable to low-income tenants. Unlike the Housing Choice Voucher program, assistance is tied to the unit, not the tenant. Tenants in PBRA units typically pay 30% of their adjusted income towards rent, with HUD covering the remainder up to a certain level. Contracts are now renewed periodically, often on a year-to-year basis, subject to appropriations. Check my video on the budget process for appropriations. The USDA Section 5.5 Rural Rental Housing Loans provides direct loans to developers of rental housing in rural areas targeted towards projects serving very low income to moderate income tenants. Many Section 5.5 properties also receive rental assistance from USDA to keep tenant contribution at 30% of income. The program has been an important source of affordable rental housing in small towns and rural communities. However, new loan commitments have dwindled in recent years. All of those programs combined are substantially smaller than the subsidies to homeowners, especially higher income ones. One economic benefit easily missed because it is not a literal subsidy is that imputed rental income of homeowners does not get taxed. Homeowners receive some benefit from their real estate in the form of housing. If they received it as income because they rented out their real estate, that income would be subjected to taxation. This kind of distortionary non-taxation applies also to all other economic activity you engage in for your own benefit, like baking your own bread. If you baked that bread and sold it, your productive activity would be subjected to taxation as well. Since it is not, the average consumer engages in too much economically inefficient home production. If this seems unintuitive to you, you probably have a moralized view of taxes, thinking, why should people be punished for baking bread in their free time? But taxes aren't punishment for bad behavior. They are supposed to raise revenues. We'd also like taxes to be as cheap as possible, so distorting economic activity is undesirable. This is a rather subtle benefit to people who live in the house that they own. Less subtle is the deductibility of mortgage interest payments. US homeowners who itemize their deductions on their federal income tax return can subtract the interest they pay on their mortgages from their taxable income, reducing the amount of income tax owed. This applies to interest on loans secured by a primary residence up to a certain principal limit. In effect, the government is subsidizing home loans, more valuable for people with larger mortgages and higher marginal tax rates. Imagine the top marginal income tax rate a high-income household faces is 70% on the last $20,000 they pay in taxes. If they can reduce that number to $10,000, they effectively gain $7,000. A low-income household may only face a top marginal rate of 30% on their last $20,000 and thus only gain $3,000 from the same tax deduction. Since higher-income households are both more likely to itemize in the first place and to have bigger mortgages, the benefit skews heavily towards them, making this one of the most regressive housing subsidies in the US tax code. Higher income households are more likely to itemize because you only itemize if the total of your itemized deductions is greater than the standard deduction, which is a fixed amount everyone can subtract without listing anything. Since the 2017 tax reform roughly doubled the standard deduction, far fewer households now find it worthwhile to itemize, meaning the mortgage interest deduction benefits a smaller and higher income slice of taxpayers than it used to. That it benefits fewer individuals is probably desirable, given that it is regressive, but that it benefits the higher income slice is probably undesirable, given our distributive concerns. A reform proposal is to turn the deduction into a tax credit, which simply returns a certain dollar amount taken out from an individual's tax payment and is therefore not sensitive to tax brackets. But it could also just abolish the mortgage deduction entirely. It probably doesn't even do anything for home ownership and instead is just a subsidy for those who buy homes anyway. Most studies find that it mainly bids up house prices in supply-constrained areas and encourages higher borrowing, rather than tipping many renters into ownership, which isn't desirable in the first place. The main reasons it persists are political, not economic. Rich mortgage owners and the real estate business are simply better organized than poor people. In addition to the mortgage interest deduction, homeowners can deduct state and local property taxes on their federal income tax return, subject to the overall $10,000 cap on state and local tax deductions introduced in 2018. This allows taxpayers to reduce their taxable income by the amount of property tax paid. Because property taxes are generally higher on more expensive homes and the deduction is only valuable to those who itemize, this benefit also tilts towards higher income households in higher tax states. These states are more likely to vote Democrat, hence Trump introduced the low cap of $10,000 where there was none before. Having a cap is of course good, but the motivation was political. A third major benefit is the capital gains exclusion on home sales. When a homeowner sells their primary residence, they can exclude up to $250,000 in capital gains from taxation, or $500,000 for married couples filing jointly. This is provided they have lived in the home for at least 2 of the past 5 years. This is a substantial benefit for long-term owners in areas with significant home price appreciation, allowing many to realize large untaxed windfalls. As with other homeowner subsidies, the advantage grows with property value and market appreciation, concentrating the gains among higher income households in desirable housing markets. All of these homeowner benefits cost around $150 billion annually, more than double the poor people programs combined. Obviously, this is all very stupid. I won't belabor the point. At least to me, this part feels kind of frustrating. There is no overarching rationale behind all of these programs. It is merely a patchwork of various different things, many of which are clearly very dumb. To explain this feeling, I just refer back to part 1. Housing is a private good that is mostly handled well by the market. We shouldn't expect government intervention in that market to produce reliably good results, and most proposals for reform in this area are simply stop doing that. Similarly, for providing housing to poor people, there's going to be one program that is most efficient, in reality probably vouchers, which we should focus all of our money and energy into. Any other, less efficient program will detract from our policy goals of providing poor people with housing. Therefore, the panoply of welfare-ish programs in housing is necessarily mostly bad. There can only be one best program, but many programs that are worse. The next part 3, deals with an area much more fraught with market failures. Financial markets. It is therefore going to be a story of a lot of good government regulation and problems that are caused by too little regulation and oversight, which ultimately led to the subprime mortgage crisis starting in 2007.